Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, December 9th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. So let's hop right in. Today's key macro question is, will the Fed sacrifice Main Street to save Wall Street again? The short answer is, while we are currently unsure of the answer to this question, one thing is clear. The Hawks and the Democrats on the FOMC now have political cover to push back against calls for dovish monetary policy via increased media scrutiny of the nationwide affordability crisis. In terms of the analytical nuance, market attention remains centered on the Fed's decision and its outlook for 2026, with the options market implying a 0.7% bidirectional swing in U.S. equities after tomorrow's announcement, a larger projected move than seen following recent meetings. While many investors are focused on the policy rate guidance, we remain hyper-focused on the Fed's balance sheet. This week's gathering marks the first central bank meeting since the Fed halted quantitative tightening in response to indications that system-wide bank reserves may no longer be ample. Beyond committing to reinvesting mortgage-backed securities into Treasury bills, the Fed has not yet clarified its post-balance sheet runoff plans. The key issue is whether the financial system retains sufficient reserves to avoid the recurrent disruptions that often arise around quarter end, year end, and increasingly month end, as evidenced by October, when banks reduce repo market engagement to reinforce cash balances ahead of regulatory and tax-related cutoffs. We are in line with major Wall Street institutions and anticipating mounting year-end money market tightness, which we've argued may force the Fed to consider dovish policy actions that rebuild liquidity buffers in the $13 trillion repo market. All told, amid mounting political pressure to address the nationwide affordability crisis, the Trump administration may be inclined to pursue incremental fiscal stimulus. Even if they do not, the hawks on the FOMC may already be less inclined to counter developing stress in the repo market with permanent Fed balance sheet expansion. Temporary balance sheet expansion is just that, a temporary solution that does not sufficiently resolve the issue of not having enough liquidity sloshing around the financial sector to sustain the accumulation of hedge fund leverage and retail investor margin debt. We reiterate our call that the 1 to 3 month outlook for asset markets remains choppy due to the Fed falling further behind the rate and liquidity curves amid historic crowded bullish positioning. Choppy may be an understatement if the hawks on the FOMC cause the Fed to push back against demands for QE in the repo market. Conversely, if the Fed incrementally sacrifices Main Street to save Wall Street by deepening the affordability crisis with more socialism for the rich, capitalism for everyone else, monetary policy, investors should anticipate an absolute bloodbath for the administration in the midterm elections and the durable headwind that represents to the 42 macro paradigm C bull market via a likely dousing of cold water on the Trump 2.0 deregulation agenda. As always, members of our global investor community can trust that our institutional grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transitioning to our 42 macro dashboard, as always, we wrap up with a question from our community. This one's titled "Using Dr. Mo to invest in any KISS cash allocation." It says, "I've just joined 42 macro. I'm impressed by the KISS and Dr. Mo's structured, data-driven approach, and have invested the family portfolios in KISS." Thank you, appreciate you guys. "I live in the UK and have invested the current 10% cash allocation in a Sterling PIMCO quid account, which has low spread costs. I'm just wondering whether I should use Dr. Mo to invest these funds in something that offers some diversification from SPY or gold. One current candidate would be emerging markets. I would revert to KISS if, for example, the Bitcoin market VAM supported this whilst the current Goldilocks environment." So excellent question. For those of you who may not be aware, it's very easy to customize KISS to your liking. All you need to do is use the Dr. Mo signals that we provide either in our published research or here in the client dashboard to figure out exactly what the amount of exposure you should have to any of the 70 factors that Dr. Mo generates proper trade signals for. If you want specific guidance on exactly how to do that, what you need to do as a DIY investor to take these signals and then use them to diversify your KISS portfolio to your customization and liking, just go to a hamburger menu up here at the top right in our client dashboard. Scroll down to the KISS FAQ section. Scroll down to the sections regarding customizing KISS. Let's see here. Yeah, right here. What if what if I want to implement the KISS model portfolio, but I prefer other exposures instead of the default SPY, gold, or Bitcoin? If I implement a customized version of KISS, how do I calculate the exposures to my preferred ETFs? So obviously, we have the answers to those questions here to make it very easy for anyone who wants to diversify away from the standard KISS, which is risk managed 60, 30, 10 stocks, gold, Bitcoin, to something that's more suitable for their strategic investment objectives, for their risk tolerance, etc. So hopefully you guys found that helpful. We'll wrap it up there. Darius still here presenting our macro minute for Tuesday, December 9th, 2025. Best of luck out there today. We will catch you back here tomorrow. Cheers.